So, when you basically putting together your investor slide deck, you're a salesperson pitching to your investors, right? So what the investors want to know? They want to know that they will make somehow their money back, and that you're thinking about it. And the only way to convey it is basically through your exit strategy slide. So that's why in your sales pitch, it's the most important slide, even though it's actually would be your last slide in your slide deck. I hope it makes sense. Also for yourself, so this is taken from 7 Habits of Highly Effective People. It's a pretty old book. I actually haven't read it. I only read a Reader's Digest version. I encourage you to look at it. But habit number 2 is begin with the end in mind. So you just want to know for yourself what you really want. And then we go to the next slide, and then you want to ask yourself, what kind of startup, what kind of company am I building? So there are basically two common ways to think about it. One is a high growth startup. You can see probably this crew from HBO show Silicon Valley, which is incredibly funny, but actually very, very useful to watch because they use all the right lingo there. And you can see this guy, potentially running a business, sitting on his phone with his laptop, but you can see that, he's not in a hurry to drive sales like crazy, and he's just enjoying life, and this is called a lifestyle business. So what's lifestyle business? Lifestyle business is a business where you may or may not have additional employees. It has a great cash flow for you, but it has no exit at the end, meaning that you probably will never sell it.
Yeah.
So it's very good for yourself, very good for your family, great for your employees, great for your local community potentially, but there will be no acquirers, and so there is no point of actually pitching to investors, and no point for investors to invest in your business. So if you want investors, you have to build a high growth business, which will grow like crazy, which will focus first on the top line, not on the bottom line, right? First, we'll focus on revenue, and then later on profits only later, because first you want to acquire as many customers as you can and all that, right? So that's very, very important. You can read more about this. But so when I'm talking about exit strategy, of course, I'm referring to high growth businesses because we're talking about the investor pitch deck. So now we're going to look closer, basically, how do we develop an exit strategy? So exit strategy has 3 components. One is you want to identify your potential acquirers, and those would be companies in your market or relevant markets, adjacent markets. Then you would like to gather some information on recent exits and evaluations or sizes of those exits. So exit is obviously it's an acquisition, of one company by another company. And third one, you want to understand recent industry macro trends to make sure that when you thinking about your business, when you kind of strategizing, and when you're pitching to investors, you're basically doing this along the line of those macro trends. And how you do it, we're going to go into tactical means here, how to do it. So first, you want to define your own market and possibly adjacent markets. Are you a SaaS company? Are you an enterprise sales? Are you a healthcare? Are you digital health, AI? And there's plenty of different markets that obviously you can look them up. So you got to have a very clear understanding and very good answer to your investors. What market are you operating in? Then you want to research recent M&A statistics. So recent means past year to 3 years. Sometimes if statistics are not good, if there's not sufficient activity, you can go back as far as maybe 5 years. M&A stands for mergers and assaults. I'm just kidding. It's mergers and acquisitions. It's a very handy word basically in this business. So there are 2 ways to exit. So let me just make a quick step back. Exit means creating a liquidity event for yourself and for your investors. A liquidity event means that you can basically sell your shares, right? When you start, you are a private company. There is no market for shares of your company. So you can sell your shares only if you're becoming a public company, and very, very few companies becoming public. So even saying that you IPO, which is initial public offering, is your exit strategy is basically just ridiculous. So you don't want to say this, right? You need to know that term, but never say that. So then what left is M&A, being acquired by another company or merging with another company. If you get acquired by another company, they pay you their cash for your stock, or they pay you their stock for your, in exchange for your stock, and if they're a public company, that's a liquidity event. So I hope this understood. Okay, back to number 2 here. So basically, you're looking for recent statistics for comparison to see comparable exits. So the sources of those statistics, there are plenty of free sources, which I would recommend looking at large law firms such as Wilson Sonsini Goodrich and Rosati. They publish free report. Silicon Valley Bank as well. There's a pitch book, but I'm not sure that it's actually free. I think it is. Some of those reports are free. And then each industry usually have what they call M&A advisory firms. So you want to, first of all, you want to get to know these firms, at least theoretically. I'm not proposing that you meet with them right away. And some of them actually publish recent acquisitions, and you can see that in those reports. So then you want to create a list of your potential acquirers, right? But not only just theoretical acquirers, but actual companies that have a real track record in acquiring somebody, because there are plenty of great companies that theoretically could acquire you, but practically they have no track record of acquiring anybody. And so if you're saying like, this particular company will acquire me, you look at their track record in the past 5 years, they only acquired one startup 5 years ago, means they probably have a change of management, and the management doesn't see acquisitions as a viable strategy for them. So then going to number 4, once you created a list of potential acquirers, now you have to divide them into tiers. And basically you do it by potential acquisition price, and what can they pay, right? Like, Google, for instance, they can buy companies for $10 million and then can buy companies for $10 billion. But of course, they could be your acquirer at every stage. But some companies only acquire, make very large investments, and I will explain very soon why. Some companies are kind of in the middle tier, and some companies are just very early on. So you need to, and these numbers are not kind of arbitrary, right? But it just gives you kind of the sense of the market, right? Even when you look at M&A advisory firms, some of them say, we are up market, some of them say we are middle market. So you just need to understand what it means. And then number 5 here is you want to understand the comparables, right? And this gives you kind of the information, what is a multiple of revenue paid by the acquirer, right? And why they paid. So multiple of revenue could be like, as little as 1.5x. Like, for instance, if the company makes $10 million in revenue, has been acquired for $15 million, that's your multiple 1.5. Sometimes, you can see as high as 30x. It's insane. It's very, very rare, but it happens too. So you need to understand that most of this information will not be available, but if you're scrappy enough, you can do Google searches and you can find this information. And then how do you understand the current macro trends? That's not easy. You could spend hours and days and weeks researching online, but I can give you one tool, which is basically see in venture capitalist portfolio companies what their recent investments are, and you will know right away what's kind of hot in the market. So what are the reasons why companies acquire other companies? So reason number 1 is technology. So usually it would be a very early acquisition. It often happens for like university startups that basically have some research has been going on in some professor's lab for years, and then they transfer this research into the private sector, start a company, and pretty quickly get acquired. Then next level is when you have so many users, so many customers. Somebody would acquire you just for your customers. They don't care about your company, how you run it. They don't care about your product, because they will merge your product into their product, right? They just want your customers. So when you grow much larger, you can get acquired for cash flows. If you're very profitable, so PE stands for private equity firms. They are looking often for deals like that, right? They're just buying cash flows. And then the 4th reason is a strategic acquisition. And I want to break it down to several. It's very important, those are most lucrative acquisitions actually, right? So one reason is companies acquire other companies for their IP or technology. IP usually it's basically patent portfolio. So if you have a very strong patent portfolio, and if you have like meat behind this, it's not unreasonable for you to get acquired just for that. Some companies want to do vertical integration. For instance, they operate in particular vertical, but use like third-party services. Maybe you are one of theirs, their suppliers, and they could buy you just for that, you know, so you become part of their product, of their offering. And so this, for them, it would be kind of a cost optimization or you know, strategy to do vertical integration. Some some large companies decide to enter, you know, to go horizontally, right? To go into an adjacent or different new market to them. And best way for them to do it, rather than just, you know, putting their marketing efforts, and you know, it may take a long time, they just acquire a company that is operating in this segment, and they just basically right there. And lastly, it's fear of missing out, that their strong competitor will acquire you, and they don't even know why, right? But sometimes it's just that's just enough to push them over the line and make an offer, make a bid on it. So here are a few tips. One is start early developing relationships in the industry with potential acquirers. Those could be like VP level people, you know, business development people, and stuff like that. I mean, C-level executives, of course. And then I mean, it's actually much easier than you think, right? Because like today you have, you know, so much separation. You're a nobody, just like me. You know, I just started a new company like 2 weeks ago, right? I'm a nobody right now, right? You know, nobody knows about me, but I just, you know, there's LinkedIn. You can, you know, you have your own network of people who can make warm introductions via LinkedIn or via email. And of course, it's worth attending industry events. Of course, you know, we have Corona going right now, so I'm just kind of taking fifths on this, right? But in general, industry events are really good. Often you can see, like, for instance, if there's a conference, so conference may have, you know, back-to-back meetings, you know, from 8 a.m. until 6 p.m. But many executives just fly to these conferences. They never attend any meetings whatsoever. All they do is they sit in a room, in a hotel room, not a hotel meeting room, or in a convention center meeting room that they booked, and they basically meet with other industry executives just for business development. That's all they do. And it's just incredibly convenient, because rather than traveling all over the country or all over the world, they have everybody in one spot. Then when you recruiting advisors or board members, you got to keep in mind that, you know, these people who you know, supposed to be very well known in the industry, and they can make introductions for you, and your board member may become your bridge actually to getting acquired, you know, and having a success story. So, okay, so the next tip, I already mentioned, that is best exits, best acquisitions are done for strategic reasons by strategic acquirers, and not for financial reasons such as like private equity firms. So strategic acquirers usually pay much better multiple. They don't even look at your revenue sometimes. They have their own reasons, and you can negotiate much better with them. The next tip is, it's kind of obvious, but it's important, get multiple bidders. So if you feel that somebody is courting you, or if you decide that it's time for you to hire an M&A firm and start shopping you around, you want to get multiple bids, because, you know, even if you have 2 bidders, that's already sufficient to go back and forth and basically, you know, get much better terms. And I'm not saying just the price, but there are many, many different terms. I went through this once. I believe me, there's plenty of terms that you will be looking at outside of the price. Then, you know, timing is important, as you guys know, in life. You know, timing, well, I said timing is everything. It may not be true, right? But timing is important, and some, you know, specifically strategic acquirers, they acquire you when it makes sense for them, not necessarily when it makes sense for you. You just think, okay, you know, I just need to, another year, just, you know, I think I'm growing like crazy right now. I have much better price, you know, something. But, you know, maybe in a year you want to have the strategic acquire you. You might have much better outcome or no outcome at all. Who knows? It's a risk. You just need to keep that in mind. I'm not saying that you need to go this way or another, just make informed decisions. And lastly, you know, I know personally of several startup founders that started their companies specifically to get acquired by a strategic acquirer, and they basically build it for that. So I have a comment here. You know, some investors actually respond very poorly when you talk about exit strategy. They say you shouldn't be thinking about exit strategy. You should be thinking about building a business, and then, you know, it will come. So I wouldn't suggest to get an argument with those investors. I would recommend you, when you're presenting your exit strategy slide, you say, I understand that my goal is I want to build a strong business, and I want to be in a position when you know, me and my board, we decide what to do, right? Continue growing or getting, you know, or exiting. But nevertheless, I just wanted to share with you that there is an exit strategy behind this. We are operating on a very active market and blah, blah, blah. So that's important. So you make this disclaimer right up front, and you basically, you know, disarm them without being upset with you talking about exit strategy. So here's an example of an exit strategy slide. What time is it now? Doing well. Yeah, we're doing fine.
Good, we're good.
So yeah, it's just towards the end. So this is an example of a content of an exit strategy slide. Of course, you'll make a fancy slide with pictures and stuff, right? So first you list potential acquiring companies. For instance, you say, you start with an industry segment, say, you know, we are potentially will get acquired by electric car makers. And then you make a short list and also in tiers, like Tesla, Toyota, and, you know, Joe's Garage that can buy you very small and stuff like that. Then you, next chapter here is you list M&A statistics. And as an example here, you know, startup acquisitions in the period, you know, from 18 to 2020. So 125 startups have been acquired by the makers. Out of them, 25 were battery making startup. And we happened, you know, I'm pretending that I am a battery making startup. Average deal size was $275 million in the range of between 50 to 500 million. And average revenue multiple was 7.5x, you know, ranging all the way from 2 to 18x. And lastly, current micro trend, they buying like crazy. They love polymer batteries. And we actually happen to have 20 patents in this area. Boom. That's would be very, very exciting to investors, right? They understand right away, oh my God, you know, they're seeing this like, you know, $500 million right here, all these multiples, yeah, we can make it. Thank you very much. That's it. Questions, please.
Thank you so much, Alex. I really appreciate that. I saw there were a couple of comments that maybe we'll start with, and then we'll open it up to questions from the audience. So I saw in the chat that it was, I believe it was Morthy, Dr. Palinki asked if it would be possible after the fact for the audience to get a copy of the slides.
Yeah, sure, of course. Yeah.
Oh, awesome. And also there was a question about I believe a pitch book. Did you you said that pitch book is free, and then some people said that it may not be free. Is it a freemium model, or do you know about that?
No, I actually said that it may or may not be free. So in general, a pitch book is it's a subscription service. But some, you know, they use, you know, inbound marketing, right? You know, marketing 2.0, where they put some free stuff. So you can actually, I believe last week I downloaded one of their free reports. Mm. But it's a subscription service. It's pretty expensive, and it targets actually VCs, right? Mm. But you can still find free reports.
And I saw there's another comment about Crunchbase is another good source. I don't know if you've ever used that.
Yeah, so I actually had Crunchbase. If you look at, like, very coincidentally, so Tanya, in your version of slides, you do have Crunchbase. I actually removed Crunchbase. The reason I removed, so Crunchbase gives you great information per particular company if you're researching, if you know what name you're using, to the best of my knowledge, right? Mm-hmm. But I don't think that you can find, I mean, unless you have a subscription, right? In the free version, I'm not sure that you can find statistics and a list of all the exits. Maybe you can. I would love to be educated. And whoever asks this question, you know, if you guys know, please shoot me an email. I'd love to learn more, of course. I mean, it's a dual-way street. It's always learn. Thank you.
Right. Yeah, I know that's the beauty of teaching, mentoring, anything. I mean, you learn as much when you present as when you attend, or maybe more, right? So I had another question here, and it was from Kieran, who was asking about why IPO is not a good thing. Why if you could speak a little bit more about why you would not recommend IPO.
No, I didn't say that I don't recommend IPO. You know, if you're in a position that you can go public,
right? I know. Right.
You made it. Go for it. You have my blessings. I can say a few things about IPO. First of all, it is incredibly uncommon, right? Mm-hmm. I don't know the exact statistics, but it's a very, very rare that companies make it to IPO. You know, go public, right? So when you're so small, when you're just starting and you have all the odds stacked up against you, you know, just even mentioning IPO, it's kind of sounds ridiculous, right? It sounds very naive.
I think it's like 2 or 3%. Maybe,
no, it's 3%.
Oh, thank you, Ray. 3%.
All right.
There we go. Yeah.
Yeah, thank you. That's a good information. Yeah, 3% actually is much higher than I thought, right? But 3% of what? That's a big question. 3% of all the startups are starting? I doubt that.
No,
Right?
it's only okay. This is from me talking as a TCA member. This is right. So
yeah.
I don't want to steal any thunder from you, Alex, but no, everything you said was absolutely accurate, by the way, for everybody who's listening. So, and just so you know, from a TCA perspective, if you come in and you say you're going to do an IPO, we will probably not fund you. That's 3% of all the funding people. Okay, so just so you know that, because it is such an uncommon event, as Alex said, that we will run screaming from you, because we're like, well, because then you get into this whole array of issues. Take everything Alex said very seriously, because what we look for is a company that's looking to exit. We don't want something called a zombie, right? And so basically, if you guys can look that up, or Alex can talk about it. So again, it's his thing, and I don't want to get into too much detail here, but the point is, everything he said is true. And if you have an investor that's saying to you, I don't want to hear about your exit strategy, you probably don't want that investor, by the way. That's just from us at TCA, we are actually looking to see that you're involved in wanting to exit, because it actually backs up everything Alex said, to the point that it means you're willing to give up ownership of your own company at some point.
Yeah.
And if you're not, we have, it's one of those also things that you may not be the right person to run this as a CEO. That's the other thing you have to remember. So when you're going for financing, everything Alex said is true, because you have to show that you're trainable, educationable, and manageable.
Absolutely.
Yeah. So I'm going to shut
up
now.
on.
But
no, thank you.
No, that's great. Thank you, Ray. Yeah, and pleasure meeting you, by the way.
Yeah, thank you.
So, I want to add one more thing about IPO. So, Karen, it has nothing to do with your question, right? I hope your question got answered by me and Ray together.
It definitely did. Absolutely.
Sure. So, one just interesting piece of information about IPO that I know is that, there's a apparently significant number of companies that actually file for IPO. They get acquired in the private markets, because there are plenty of M&A firms, right, and investment bankers. They live for those deals, right? They make tens of millions of dollars on those deals. So what they do, they always on the lookout, because the filing for the IPO becomes public information. So they scrape this information on a daily basis, and they basically approach those companies and offer them deals. And actually, for any company, usually who filed for IPO, it's much more lucrative for them to get acquired in the private market, because private acquisition pays better actually than the IPO, and IPO is unpredictable, and it could be a flop, obviously, right? And IPO comes with a significant sticker price, by the way. As I said, tens of millions of dollars, right? There's plenty of people who who make their living around IPOs. So. Anyways, that was kind of side note.
No, thank you. I appreciate that. So there's a question here from Isaac. Isaac, did you just want to ask the question yourself? If not, I can ask for you. I don't know if your microphone is on. So I'll go ahead and ask the question for Isaac. So he wants to know a little bit more about why you sold it and how you knew that it was the right time to sell, when was the right time to exit.
Okay. Well, so I actually have about 20 slides just about that story. But basically, I got acquired by my strategic investor. So we picked up this strategic investor relatively early on. So I had like 3 rounds of funding in my startup. They invested in the second round and third round. One of their C-level executives was on our board. And they actually acquired us for strategic reasons. And the acquisition, it's a very interesting, cool story, but in a nutshell, so they were using our product, for a while internally, and they understood the potential and everything. And they all of a sudden found a kind of an unintended use. They basically used our technology platform for not completely, but pretty much very different. We didn't even think of this as a viable use, right? And they asked us to help them to re-engineer it, and it turned out that it required no re-engineering. They could use it as is almost So they got super excited and they basically bought us because, so we didn't have a lot of sales. We were just getting into growth and product market fit, but they bought us because we had 5 issued patents, or maybe 4 at the time, but now it's 5. They bought us because, as I said, they knew the product intimately, and they found an additional use to this product, and they really wanted to own the platform. And also, they tried to develop it with this platform, without realizing that they can use ours. They tried to develop it with a contract engineering company in the Bay Area, and they got a quote which apparently exceeded $3 million. So it was a no-brainer for them to just whatever. So the deal was not huge. I cannot, unfortunately, disclose who acquired us in public and for how much, but it all fit well for them to acquire us. I hope I answered your question, right?
Yes, you did. Thank you. And when founding the company, did you have an exit strategy in mind?
I wasn't as sophisticated back then, to be honest with you. I realized that I need to talk about exit strategy, but I am incredibly embarrassed by my slides back then. But in general, I'm embarrassed of me yesterday. I think I always how foolish I was yesterday, and I learn every day. But if somebody just gave me this talk that I gave you today, I think I'd be much better off. I'm not trying to compliment myself. I'm just saying that this is an important knowledge to have.
Yeah, so that's kind of why you do this, is because you believe that it's important and can help companies early on.
Yeah.
Nice, very nice. And also, do you have any regrets about selling your company?
Oh, not at all.
Not at all.
Now I got my war chest. I go brag around and exit. I have a bunch of investors in San Diego. By the way, speaking of TCA, so Ray, I actually, less than a year before the exit, I actually pitched to TCA. I got all the way to due diligence. You guys, instituted this 3-hour due diligence. It was very intense. And
yes, I know those well.
It was great, actually. I really enjoyed that. And I got a quick no, but I thought it was going to a yes, but in any case, it is what it is. Moved on. I still like you guys.
So just so everybody understands, what ends up happening, just even to get to pitch in front of TCA, we do about 12 to 14 a month, is a big deal, because there's at least 3 times that many that don't get to pitch. We flush them out. And just because you pitch doesn't mean you'll get money. We gave away $3.8 million in the last 6 months to companies. But the challenge is that 50%, even after their pitch, and we do a thumbs up or thumbs down immediately after the pitch, about 50% make it into that. And then even then about 20% get bounced off of the due diligence. And those are 3-hour proctology exams. I call them proctology exams. I apologize. I don't even know if I can say that. Okay, just raise your hands, HR. But basically, they examine you inside thoroughly for every single angle you can think of, financials, IP, the whole board and everything. And one of the things is I did see the question again about being in the long run and stuff like that. So understand, most of startups are in it for 5 to 10 years. We've had an exit after 12 years. It just takes time. If you think you're going to start a company and get out in 3 years to 5 years, it's possible. SaaS companies have a great possibility. SaaS companies actually might make it, to IPO, but everything else probably not. And it just takes a while. And so what I would say to you guys is that listen to what Alex is telling you. He's been through it on the other side. And the fact is that we believe that if you're pitching to us, that you're in it for the long run. We will flush you out in due diligence if you're not. Trust me. I mean, it'll come out. Something, you'll say something or something will. So either you're emotionally in it for the long run or you're not, okay? And we'll know. And the other thing is that if you're talking about an exit strategy, we do not take that as a negative. We actually take that as a positive. That means you're thinking about what's going to happen in the near or far future, right? So again, everything he said is accurate, and do not worry about who is that, Regina? I'm not trying to point you out, but I'm just want to make sure you get this, is that it actually shows a maturity of you that you're thinking about how you can get out and that you've looked at strategic investors. Okay.
And I'll actually ask Alex if you'd like to weigh in on this as well. So Regina was asking that question. If investors do want to see that you're in it for the long haul, and they want to know, or she wants to know what you think about that skin in the game mentality. If you talk about the exit right away, do you feel that that's also, as Ray does, that that's a good thing to have that as part of the initial presentation?
So it's a great question, and it's a great point too. As I said, I just want to go back and re-emphasize, right? Some investors actually take it as a very positive. Some investors take it as very negative, and it's kind of for whatever reason, it's pretty polarizing, right? So what you need to do, you need to when you just put the slide on, right? You get to the slide, you start from a disclaimer. You say, look, guys, I completely understand that it's like maybe even premature now to talk about exit strategy, right? Believe me, it's a startup, is my baby. I'm going to be with it until we exit successful, right? And I know it could be a long haul. I am in for a long haul. But I just wanted also you to know that I'm thinking about that my job as a CEO, right? I report to my board, and my fiduciary responsibility as a board member to think about my investors, right? So actually, at the end of the day, I am here to create a return for my investors. How do I create return through exit? So here's my strategy, as I understand it now, and of course it may change over time. I also wanted to use this opportunity to compliment TCA, when I went through this process, and also share a tip. So when Ray said that it's very hard to get to even the initial pitch to their intake committee, it's absolutely true, right? And the way to do it is use your network. It's always, have warm interest, right? I am very well connected in town. I had the luxury of being able to pick from multiple sponsors. So I had a sponsor basically, right? Somebody who said, hey, I know this guy, he's real deal. I recommend that we look at his pitch. And then of course, after that, it's all you, right? You got to pitch. So I've pitched like 3 times, I think, like intake, and then the big one, and then something else, which I forgot. Maybe it was that one.
Do you think, Alex? Oh, sorry, go ahead. Keep going. I didn't mean to interrupt.
Yeah, and I also wanted to say that, I was very pleasantly surprised about this due diligence process because for several reasons. First of all, the time between my last pitch and the due diligence meeting was only 2 weeks, as you promised, like on the dot. It's incredible, right? Second of all, there were no questions. How would I put? No irrelevant questions, or no questions that could have been answered in the materials that I provided. So the due diligence team truly did their homework. Yeah, they bombarded me with very tough questions, and some of them, I had to say, what, I don't think I thought of this. I apologize. I either need to think now or maybe get back to you later. Stuff like that, right? So you basically need to be honest, right, about what's going on. But the point is, it was a great meeting. I've learned a lot. I've enjoyed it, and almost got an investment.
That's awesome.
Sorry, Tanya. So now,
I actually had a question myself. So I was wondering, do you think it's helpful to really do your due diligence in who you're pitching to, and what their their views on talking about exit strategies are, and knowing who you're pitching to?
So it's a great point and question. Yes, absolutely. You have to do due diligence on your investors, right? But reality of life, as a startup CEO, you're responsible for so many things, and you're going to end up, pitching at least 100 times, if not more, per each round, right?
Right.
So there's just it's pretty impractical to do like real deep dive onto your investor. And in particular, how can you know if this investor, cares about exit strategy or not? Unless you find some. So you do like quick, LinkedIn profile, like web presence, social media presence, and then you see if you connected to this person through. Oh yeah, and then you look at their portfolio companies, only they advertise it, right? And you can see it on LinkedIn or on their website. And so if you know somebody, some CEOs of those portfolio companies, you reach out to them and say, hey, I'd like to talk to you about this guy or gal, right? What ticks them off, what kind of questions they ask, what they care about, and then you can learn about this. Yeah, if you talk to somebody.
The biggest challenge you're going to face in all of this is that, and my suggestion would be, do exactly what Alex said. Try to find a strategic investor in the space in which you're working in, or somebody who believes in you, because we're also going to look at your board and we're going to look at your advisors, your true advisors. And so if you have an advisor that is something that's in the space that's really important, that may be the person that gives you the biggest problems initially, because like you said, that initial investor may not want to hear you saying, I'm going to leave. As a matter of fact, a lot of times when you get bought up, you've got a 2 or 3 year stickiness, meaning you can't leave, and generally there's a contract where if you get bought up, you're working for that other company for 3 years, and you're not starting anything up, and you can't do anything that's
Competitive.
competitive. So just remember that. So this is the start of the beginning of a very long adventure for you. You got to be thinking 5 to 10 years out in what you're doing right now, and you got to believe in it in that way. So that's why I'm saying, I bet most everybody on this thing. And oh, by the way, I don't know if anybody understands, I'm actually have a startup in the rec. I'm here as a startup guy, not as anything else. So just so that I just happen to have all this other baggage. But the point is just so you know, even as a member of TCA, I have not brought my startup to TCA yet. And everybody knows me. So, and I've been going at this now, my startup, for about 1.5 years. So that just gives you an idea, because I kind of know what I have to get together. So the worst thing you could do is go to a place like TCA too soon. I mean, it's not actually that bad. We're very accommodating. So if you come to us too early, we'll say to you, go away and come back when you have, a couple of other things under your belt, okay? So, but there are some people that if you go to them too early, will not talk to you again. Be aware of that.
Yeah.
Absolutely.
Right.
So thank you, thank you, Ray, for that input, and thank you, Alex. We have just a couple more minutes to go. Do we have any other questions from the audience? Feel free to, like I said, either put them in the chat or you can just ask outright.
Yeah, I was going to ask Alex, so I don't know if you can share this, but in terms of you being acquired, so does that mean that you gave your full amount of equity in the company to that acquirer, or did you have full equity in the beginning and you gave that?
And can you introduce yourself, Isaac?
Yeah, I'm Isaac Javed. I'm one of the student founders.
Yeah, so Isaac, the acquisition is, they basically buy your entire company, all the shares, right? And then, you basically calculate your share price as, the acquisition price divided by the, total number of outstanding shares.
So I guess what I'm saying is, did you have 100% equity, or was that?
Oh, no. I've raised $1.5 million. I had 20 angel investors. I had the strategic investor, not even close. Yeah.
Okay.
Also, you got to be aware there's so many nuances. There's a waterfall distribution. It means it's not equal distribution. It's basically, people get, debt holders, get paid first, or actually it's not even true. Your suppliers get paid first. By the way. So if you owe money to your suppliers, that's first. Second is,
Alex, I was just gonna say, this is Ray talking again. To answer that question, Tanya, you may want to have a whole nother section for Alex to go through, because what you're really talking about is cap table generation and the output of that cap table into the actual financing aspect, and then the strategic sell-off. So
yeah, agreed. We could have come
you
back.
could have hours on that.
I know,
yeah,
right?
Exactly.
There's a lot of rabbit holes we could definitely.
Yeah, so there are many nuances there. I mean, I actually have a deck that I present. That's a starter accelerator asked me to come in and share my M&A journey, right? My exit journey. So I have a separate slide deck that also I could probably deliver to in 15 to 25 minutes.
We do have another question here. It's from Arash Adami. If you want to ask yourself, you're more than welcome to, and if not, I can ask for you. I might not have his microphone on.
No, I'm reading.
Oh, you can see this. Okay,
yeah. So absolutely correct. Life sciences and medtech and biotech, usually take longer.
Yeah, so he's asking, how do you frame your exit strategy with investors when it's 5, 10 or more years out?
So even if I answer this question, it would be uneducated. So my disclaimer is, I worked for biotech, right, as an employee, but I never started a biotech company. I recently, a year ago, I started medical AI company, but I quit as a CEO now. I'm just a shareholder and a board member. So, but even there, we already have, we do have an exit strategy. So I think that my common sense tells me that it doesn't really matter, exit strategy is exit strategy. That's why when I said you divide your potential acquirer into tiers, right, on the amount of, how much they can pay for you. That's actually, it's not a dollar exit, it's a time exit, right? Because your value is supposed to be increasing over time, right? So let's say if you get acquired in 3 years, right? Somebody may pay, I don't know, 50 to, like depending on how much money invested and what's your IP and everything, right? You may not even have a product in 3 years, but somebody will acquire you just for your IP, and it could be just a nice acquisition of tens of millions of dollars. And then, if you launch your product and you grow successful, then somebody will acquire you for this product and market share and whatnot, for hundreds of millions of dollars and so on. So 5 to 10 years out is still fine. You just don't put these years out. It's kind of implied, right? You say, hey, I have Illumina can afford buying me for over $500 million, no problem, right? And then, there's like several startups, several life science companies, and even in San Diego can acquire me, between 50 and $200 million, something like that. Does it make sense?
Absolutely.
Anya, how many life sciences startups do we have?
So yeah, so in our in the rec right now, we don't have. I'm trying to think if we have any life science. I don't think we have, but I know we do have. We just developed a relationship with some life sciences startups that might be coming in next in the fall.
So from a TCA perspective, just so you know, life sciences, to answer for Arash, we don't generally anticipate you going full term on either a life science, what you call life science, bio, so medtech or biotech. Mm-hmm. We expect those to be taken out of because the evaluation period through the FDA could take years. So what we believe is that if you've got a strong IP portfolio and you have a very strong story, remember, everything is about a story that you're pitching. So if you have a strong story, you have strong people in the field that are potential purchasers, and you have some IP that goes along with it, and you're at least starting into the FDA trials, we usually 3 to 5 years in, we expect you not to survive as an independent company for much longer. Mm. That's what we're looking at. Yeah. So bio and medtech are completely different than most everything else. And we have, by the way, if you've got one of those, we've got very, very strong people in TCA in that space. So please come talk to us.
Absolutely. So we're just about out of time. I do want to invite Alex if there's any kind of closing remarks that you'd like to make. And I'd like to encourage everyone to please, there was a survey that we did put in the chat. And if you could take a moment to just fill out that brief survey so that we can give feedback for us and also for Alex moving forward, and that we can make sure that we continue to give you workshops and presentations that are useful to you and that you'd like to see. So Alex, is there anything that you'd like to share with us?
Yeah, just a couple of things. So one is I will, somebody asked about slides. I will email you these slides. Please don't distribute because I've made some updates. Okay, so I will email slides in a few minutes.
Okay.
And then last, I just wanted to quickly, share with you about my new startup called Productified. It's basically a platform to support the inventors and entrepreneurs to turn their ideas into products. And we are very early on right now. We just raised, we raised $300,000 in seed capital from a local startup studio called Launch Factory, where they're a portfolio company. We're getting like free office for 2 years and some services from them and advice and everything. And, we are interested in your opinion. So if anybody is willing to talk to me privately, basically, if you guys developing a product, not necessarily building a startup, but have some product ideas, just can put a head of an inventor and just talk to us as a customer interview. And this could be a dual-way street. I'd appreciate it. You have my email address. Please feel free to reach out. And even if you don't want to talk to us, if you have any follow-up questions, again, please feel free to reach out, and I am on your Slack channel as well. Thank you very much for listening and your questions. Tanya, you're muted.
Thanks, Alex. Yeah, the rookie mistake there, huh? it must be back first time back this semester. So thank you, I appreciate that. So I was just saying thank you everyone for coming. I will share those slides with you in our Slack channel. So if you're not in our the Rec Slack channel, please join, and you can find that address on our website. Thank you all so much for coming. Thank you, Alex. We will we'll be in touch for sure. And I hope we can do another presentation like this. I hope to see also all of you at 2 o'clock, those of you who are interested in mentoring with the students. Thank you, everyone. This was a great information, and just love the presentation, Alex. Thank you. Bye, everyone.